Is your house that you live in an asset or a liability? Well, Robert Kiyosaki from Rich Dad says that an asset is something that puts money in your pocket each month, and a liability is something that takes money out of your pocket each month. So the house that you live in, according to him, is not an asset, it's actually a liability. But everybody says that the house that you own, that's your greatest investment, right? But this is the difference between people that are really wealthy and the middle class, is they define assets, things that they think are assets, they actually really are liabilities. So we have over 150 million in real estate assets that we are general partners on in the Southeast. And I choose to rent in the Los Angeles area, and I'm going to show you why I do it, because I feel I can get much higher returns and it's much safer to do this. And so we're going to go over this in 3 easy steps, and I'm also going to share a great quote at the end, so please stick around. I think you're going to like it. Okay, so step number 1, your house is not an asset. I'm sorry to burst your bubble, but it is not an asset. I want to share with you, this is the house that I live in Pasadena, California. You're gonna probably, some of you may actually die of shock when you see this, but it's a 3-bedroom, 3-bath house. You can see it here, 1,250 square feet. The going rate for a house like this, it has a small back patio and a front yard, and it goes for around $1.2 million at the time of this video. I know in Alabama, some of you are saying that'd go for about $120,000, but $1.2 million here. So while this is not HGTV, which I love those home shows, those are really fun, I'm just gonna explain kind of how this works. So typically, when you buy a house, you're gonna put around 10 to 20% down, so that would be somewhere between $120,000 and $240,000. My rent currently for this place is $34.50 a month. Again, some of you are dying of heart attack because of the shock of how much that costs. But according to Zillow, if I were to put my down payment of 10 to 20%, my payment on this particular place would be $5,713. And again, for a value of $1.2 million, that's what the mortgage would cost to cover this. So you can see there's a delta there of around almost $2,300 that I would need to pay to own this rather than to rent it. So some areas, maybe where you live or wherever you are, it can actually cost more to own than it costs to rent. Now, this has not always been the case. This is not the case in every market, but right now where I live, this is the case. And that's what you need to look at, is where you live, what are those differences between owning and renting? And so let's just play this out for a second. Let's say I buy this house for $1.2 million. I take the money that I could have invested, whether it's $120,000 or $240,000, I invest that into the property as my down payment. And let's just say the value of this home goes down by $100,000. So it goes from $1.2 million to $1.1 million, which is not a big move. It's about an 8% move, less than 10%. It goes down just a little bit. Well, in that case, I'd have a choice. If, let's say, I wanted to move to another area, or I wanted to buy a different house, I would have to pay $100,000 for the privilege of selling this house, right? I would have actually lost $100,000. Another thing is you'd say, well, I just rent it out. We'll go back to our equation of how this actually works if you rent it out, right? So the payment is $5,713, but the rent is only $34.50. And you have your cost to be able to maintain that place. So you'd be paying at least $2,300 plus, any management fees, any sort of maintenance, anything like that. So probably somewhere between $2,500 and $3,000 or more, just to have the privilege of still owning this house without living here, which I think is absolutely crazy. So again, go back to the definition that Robert Kiyosaki gives. Is this an asset or is it a liability? And I think today, with interest rates rising, or they're talking about raising interest rates, at least at the time of this video, they have started to raise, at least mortgage rates are starting to come up because everybody's expecting that rates are going to rise. So anyway, something to be concerned about when it comes to actually owning and whether your house is an asset or a liability. Now we're going to talk about opportunity cost. Okay, so number 2, what is the opportunity cost of you renting versus owning your home? Now let's just say I did decide to buy this house. I put 10 to 20% down, which we said was between $120,000 and $240,000. We'll find the middle of that, which is $180,000. And let's say instead of buying, I took that money and I invested in an investment that could get me 15% per year. And before you say, well, that's a pretty high investment return, there are some ways to be able to do that, which we'll get into in the next step. But I took that $180,000. I took, basically, I would be getting $27,000 per year. And it would bring my first year total amount that I had from $180,000 to $207,000. Now, after 5 years, if I just continually had this 15% return, I would double my money. So from 180,000, I would go to 360, and I would be getting passively $54,000 per year from this income stream. That would be around $4,500 a month, which would cover the rent. Right now the rent is $3,450, then it would be $4,500, and that would cover, likely even with inflation, that would easily cover the amount of rent that was there. So now also you need to look at, when you consider this, the idea of renting versus owning. Not only would I save the money on the down payment like I just mentioned, but I would also save this close to $2,300. It'd probably be even more than that, because there's other costs involved with ownership, such as repairs or maintenance or other sort of things that happen when you own a house. Well, let's just say conservatively $2,300 a month I would save, because that's the difference between the renting and the owning costs. So if I rented, I would save this $2,300, and over 5 years, monthly, if I just got 15% per year, it would bring the $2,300 would turn into $208,567.38, which is astounding, right? Another $208,000 that you would just save by renting versus owning. Now, that would basically assume a 15% return. Now, if I took that in combination with the $180,000 that I got by saving what I would have put into the down payment, that brings the total to $388,576.38. Now, you could say, well, that's true. Okay, you would have saved this money, you would have been able to invest it, you would be able to have that ability to do that. But what about if you own a house? It can appreciate, right? A lot of houses appreciate. Well, the house would have to appreciate over the next 5 years $388,000, which is a 32% increase of where it is now. Now, could that happen? Absolutely, it could happen, right? Could single-family housing in this area appreciate? It totally could. It could go up, substantially. This house could be worth somewhere around 1.5, 1.6 million. That could absolutely happen. But what happens when rates rise? What happens as rates continue to rise if affordability starts to go down and people start saying, it just doesn't make sense here. I can rent for so much cheaper than I can own. And those are things that are really concerning, and especially in this area. I know some of you may not have this in your state, but here there is rent control. So they can't raise the rent right now more than 5% per year. And they're talking about potentially limiting that somewhere to be between 2 and 3%. So, again, it is much more limiting, at least in this particular market, to own than it is to rent. So I'm going to get into some alternatives that if you decide to rent instead of own, where you can apply your resources. Now, again, I'm not your investment advisor. I'm not giving you specific advice, but I want to talk about these alternatives. Okay, so what are the alternatives if you decide to rent instead of buying? Where are you going to put that money where you're going to get these great returns? Well, again, let's go back to the definition. An asset is something that puts money in your pocket each month. So what is a good investment? Is a fancy car a good investment? Most likely not, because it's not going to, even if it's a great car, it's not going to put money in your pocket each month unless you rent it out on a service like Turo or you're using it as some way to produce income. But in general, the answer would be no. What about a house that you live in? Well, we kind of went over that. Generally, that is not considered an asset. But what about an investment property, right? That can really be a good way to develop an asset, something that will put money into your pocket. What about the stock market? I would say in general, no. And sometimes dividends, some of them can put money in your pocket potentially, but there's a lot of volatility, and I think we're coming into a time where we might start seeing more volatility in the near future. So we talked about single-family rentals. Right now it's hard to find anything that's cash flow positive, meaning that the rent is higher than what the mortgage would be. But let's go over an example. Let's say you could find it. And for me, I had a few years ago, I had a small single family portfolio, and I was getting $100 a month per house, let's say, and I was hoping for appreciation. I was praying for appreciation. I was hoping it would come, right? Because you just need the value to appreciate, so then rents to rise, and for the value to be able to increase. But one thing I realized is that, especially for me at the time as a working professional, I really undervalued the time that I spent working on my real estate. What I mean is the time it took to go look at deals, the time it meant to go, get the financial statements and review that if there was an issue. And I even had property managers on all this stuff. So I was paying money to property managers and I was still getting headaches. They would still call me, hey, the toilet's broken here. What do you want us to do? The tenant didn't pay. Should we evict them? I mean, there were just things that were happening, right? And you can say, well, that's not your experience and that's fine. But again, the thing to look at is if you were to get 10 more houses, would that be overwhelming to you? And if the answer is yes, then it's really not a passive investment. It's really not scalable because it takes a lot of time to be able to go get these things. And really, time is the most valuable thing, particularly if you're a professional, if you're a business owner, if you're a retiree, you're someone that really is worth a lot as far as your time. And I think we all, in some ways, can really undervalue our time if we're not kind of trained to think this way. So something to really think about. Another great consideration is commercial real estate. They did a survey and they found from people that were worth over $100 million, which is a lot of money, that the highest percentage of their net worth was in commercial real estate. And one of the primary commercial real estate focuses for a lot of people is multifamily real estate. And some of the advantages of multifamily is you get tax advantages where you pay no taxes or you can defer the taxes. There's an inflation hedge, meaning the more money they print, you own an asset, and rents generally rise with inflation, as you can see here. You can see that, in the worst point of the Great Recession, it's actually a much more stable asset. Large multifamily versus single family, there was a 10 times less delinquency rate, meaning the owners were behind on the payments 10 times less in large multifamily versus single family, as you can see. It actually has much better returns when you compare it to the stock market, obviously less volatility. And also there's something that we do in multifamily syndication, which is a way that we structure deals for passive investors to join us on our deals that we do. It's called a value add component. We come into a property, we do some renovations, we're able to see some rent increases just kind of as people move out. Before the new people move in, we do these maybe $8,000 to $10,000 a month in renovations, and then we see a rent bump which dramatically increases the value of the property. So if you're interested in learning more about multifamily, we do events each month either on inflation, we talk about inflation, or we talk about multifamily. But this one talks about multifamily investing, 3 of the best operators around. You can check it out up here, just talking about how that works and what a great deal looks like. So check that out. This quote from Warren Buffett. Warren Buffett's one of my favorite guys to listen to, but he says this, he says, "It's only when the tide goes out that you can see who is swimming naked." Quite a visual there, right? But it really is important that in the time when things are very hot, when it comes to single family, comes to other types of things, it's important that you start thinking about what are some ways that I can position myself to where I'll do well even when the tide changes, right? So consider that, look at that. If you're interested in learning more about multifamily investing, we also have this free report that I wrote. You can check it out below. It's called The Single Best Investing Strategy During and After a Pandemic. So check that out. And I want to hear from you in the comments. Do you think that owning is a bad idea, or do you think you should do it? So write down in the comments below, consider subscribing, and we'll look forward to seeing you on the next video.